Hi there, my name's Oli Knight. I'm here in London to record a very special episode of FinTech Focus here at Quant Strats in London. I'm here with Mathias Piardon from 1L Capital, based in Switzerland. Here to talk all about funds of funds model, multi-manager, and how to build a competitive fund in this increasingly dynamic landscape, and also some other things that naturally come up. I think, first of all, probably where I'd like to start is from your presentation yesterday, talking about portfolio construction, building a robust kind of multi-asset class portfolio in this world. Perhaps first of all, you can just kind of outline to us some of the challenges that funds particularly face in 2025 and on that kind of topic. You know, why is it that perhaps there is a need to approach this topic with a renewed context or with a slightly different perspective?
Are you talking about funds in general or multi-manager or funds of funds? Or
in the global context? Funds in general, global context.
So in the global context, I would say it is not a new environment. It is an environment that has already existed. There's competition, that has been competition with private firms, private equity deals in the last years that has faded away. There's increased interest in the hedge fund space I've seen recently. Talking to very large allocators of wealth management companies who are looking to allocate more into the hedge fund space. So I think there's a good dynamic going towards the hedge fund space. Now the thing is, the whole question is about, do people want to structure their own portfolio, individual allocations directly into funds, go through a managed account platform structure, or go through a multi-part structure? And that is the topic that is actually the challenge that is coming up now for allocators. How do I invest in alpha strategies?
And I guess from your perspective, running a fund of funds multi-manager, how do you approach that? How do you see that? And so what benefit perhaps does a platform like your own hold to potential portfolio managers?
So we're not a fund of fund. Okay. We're a fund of a multi-manager structure.
Right.
So we don't invest in funds. We actually select managers with good alpha strategies to manage a managed account under our fund. So we're a multi-pod, like the big ones, right? Millennium and so on.
Sure.
With a different approach, different structure and so on. What is the benefit of that? Is obviously you don't have a different layers of fees. We do the whole portfolio construction. We have a transparency. So when we select a manager, our LPs, our investors are reassured about the fact that we have a full transparency. We know exactly what risks the managers are taking. If there's a style drift, we can give a quick call to the manager, or in the worst case, terminate them on the spot and control the overall risk, right? Because when you do a portfolio construction, when you're an allocator and you select different funds, or when you're like us, a multi-manager structure, you want to make sure your portfolio construction doesn't get distorted by a style drift by one manager or another, and that they all operate within the mandate that we're given.
So on that note, are there kind of core principles or values that kind of guide how you combine all those different portfolio management strategies together into one kind of effective product?
Yes. So it's a pretty bottom-up approach.
Okay.
Where we see each manager in its own merit, each strategy in the context of like market environment, what they can deliver. And we do our portfolio construction this way. And obviously we expect the managers to carry on like working within this context, within those risk parameters. And then it's a successful story for everyone, basically. And that allows us, to have sort of permanent capital with the managers, which is what they're looking for. They don't want investors, to say, oh, I'm going to put in my money. If I had 6 months, you have a bit of drawdown, I withdraw my money. We would say, okay, you're still operating within the context of like the risk parameters we've decided and we've agreed on. And it's a bit difficult, but it doesn't matter. We know the strategy will come back at some point. And it's quasi-permanent capital we have with the managers.
You mentioned earlier about how you're multi-strat and kind of similar to a Millennium or something like that, right?
Yeah.
But obviously very different at a similar time, right? Something we were talking about before was the kind of this age that we're coming into now, and the way in which different multi-manager shops might want to position themselves for a competitive advantage.
Yeah.
Interested how you view yourself in kind of where you sit in that space, and perhaps what advantages that you have in comparison to some of those
big ones. So it really depends on the conversation you have with the managers and the deals you do with them. We have payouts that are higher.
Yeah.
We have risk constraints that are not on 80 different factors, but are very tailored to our needs, which is a bit more flexibility. And more importantly is, well, as important is we don't ask for exclusivity with the managers. They can have other mandates, they can work for some other things, and we support them. We try to say, okay, if you're good with us, how can we help you to grow your business independently? You'll still manage our assets, but potentially you can have some other mandates, and we can introduce them to some other investors. This is everything we can support for. We can bring as a support for the managers, and it's not about how much sign-up bonus you will pay for each of them, because the bigger guys will have a bigger check, but it's how much added value you can have to the manager. Because at the end of the day, a lot of the managers, they want to have their own structure, want to be independent, they want to be able to run the show, and they don't want to be on the hook with someone who can pull the plug anytime. So we want to become real partners, which we are becoming with a lot of different traders and portfolio managers. So we currently have 25 managers. We're looking to add 1 to new manager on a monthly basis, increasing the ticket size as well, and building up bridges with large asset allocators, where if we have successful managers with us, they could get allocations for large allocators that have between 10 to 50 billion.
You mentioned, I believe on the website it talks about kind of almost prop-esque payouts, right? I wonder if this is something that, it's almost indirect, as you said, kind of like almost a direct opposition to that world of the big multi-strats where they paid the big sign-on bonuses and that sort of thing. How do you find that kind of narrative of come here and we'll give you a much higher kind of skin in the game, a much higher cut? How do you find that kind of resonates with the talent pool that you speak to at the moment?
Well, obviously we like it.
Yeah.
It's very interesting, right? They obviously like that. There's, constraints and risk limits. They have to make a co-investment with us, right? We put some capital. Right. They have to put up capital. They have capital at risk. But it's to the best of the alignment of interests we can have, right? It's really about finding the real partnership and not, one partner in that relation trying to sort of abuse the other one in the sense of, hiding things or doing things differently. It's like, let's open up about your strategy, your risks. Let's see if there's a match with us. And then let's find the right deal in full transparency, how much we can pay, how much you put up, how much we put up. And to make sure it works for both parties. And that's the real partnerships you can build, the long-term partnerships you can build with those people.
On that note, I think both aspiring and current PMs would be interested in hearing kind of, I suppose, what it is that you look for from a kind of a candidate,
Yeah, absolutely.
I'm curious, is it track record? Is it
not especially?
What are the things that come to mind?
No. So it's, we're working with managers who will be spinning out of established structures, or actually even people who might come from the academic world and have a great paper, have been trading a little bit of their own money and have something really interesting. You can look at that as well. And we have $1 billion plus to already established hedge funds, right? They want to run a new strategy, launch a new product, and they do that with us. So what we're looking for is our strategies that are very alpha-oriented. We don't ask for especially a high Sharpe ratio. It doesn't really matter. It's control of volatility, control of drawdown, diversification of instruments, or control of idiosyncratic risk with active stop loss orders, or ways of degrossing in case you realize volatility increases. Those are the things we look for. It's about, if we tell a manager, for instance, your max drawdown will be, 8%, 10%, we're not going to ask them to make 40% a year. It doesn't make any sense, right?
Sure.
You have to stay realistic. It's like, we have managers to say, okay, with a max drawdown of 10, I can maybe make 7, 8%. That would be good enough for us, because if we focus on alpha, there will be orthogonality with the other strategies we have. It will add diversification and improve our ratios. Our end product has an incredible Sharpe ratio that you only achieve in HFT firms, things like that.
Sure.
And you only achieve that in a multi-part structure if you get this orthogonality in the strategy, and that's what we're looking for. So we say strip out the beta component, focus on alpha, and then there's something really interesting in there.
That's interesting. I think that might be refreshing for some people to hear, because I think the classic kind of boutique multi-manager model, I think, could be criticized, perhaps fairly, for prioritizing certain vanity performance metrics. You mentioned Sharpe ratio.
Yeah.
I'm not saying that's necessarily a pure vanity metric, but sometimes it kind of escapes into that. So it seems that you offer quite a customizable and kind of flexible view on kind of the value of a strategy.
Yeah, absolutely.
Yeah.
We look at that together with the manager and decide if it makes sense for them, for us, and then
And it seems like there is a desire to bring people in and actually help develop them or help grow with them.
Yes, absolutely.
Which I think, again, kind of stands you out from a lot of these other multi-manager platforms.
Absolutely.
Yeah.
It's, the manager wants to at some point say carve out and go and say, oh, I'm going to do something else. That's absolutely fine. They want to have access to, I mean, we're based in Switzerland. If they want to have access to Swiss private banks, wealth managers, we help them in that regard. We introduce them and we help them grow the business. And there's, that's the real partnerships we want to do.
Excellent, cool. And look, we're kind of, I guess, halfway through day 2. You had your own presentation yesterday. Just curious, how have you found Quant Strats London this year so far? Anything that's particularly struck you, or anything that you found interesting? Or
I found it actually really, really interesting, because it's the content of the panels, of the discussions is pretty deep. There's a lot of insight from a lot of the service providers as well. So it helps to see how the environment is, the new hedge fund industry is taking a new shape, a new form, how it's evolving. It's really refreshing, I have to say. I'm happily surprised by the event.
excellent, cool. That's great. Thank you.